Hey guys, today we'll be reviewing The Intelligent Investor by Benjamin Graham. Benjamin Graham was a mentor to Warren Buffett, one of the richest people in the world. As a teen, Buffett read a copy of The Intelligent Investor and he remarked that this book changed his outlook on investing. There are many ways to invest, such as in real estate and in business, but for the purpose of this video, we will be talking about investing in the stock market. When most of us think of investing in the stock market, it seems very daunting. There could be an economic crisis, and all the money you put in just might disappear. Some of us think that investing in the stock market is gambling. However, this is not the case. Benjamin Graham proposes a way to invest in the stock market which minimizes risk. He calls it intelligent investing. Intelligent investing is a long-term strategy that focuses on analyzing a company's worth. This includes analyzing a business's principles and its long-term progress. Graham also mentions that this is different from speculating, which is more of a short-term strategy. If, for example, you hear that Nintendo is going to release the new Nintendo Switch, then you start to buy stocks from Nintendo in hopes that the price will rise so you can sell them at a higher price. Although this might sound good in theory, this way of investing is more like gambling. You are basing your investing decisions on information you heard, and the information may or may not be true. What if you bought the stocks from Nintendo when it was super expensive, and then when they released their Nintendo Switch, the product completely flopped and the stock just plummeted down? There would be no short-term monetary gain, and whether you gain or lose money would be based on chance. Again, intelligent investing is when you focus on the long term and not the short term. In the long run, more money will be made and less will be lost. Graham mentions that there are a few principles that should be followed in order to be a successful intelligent investor. One principle is to always diversify your investments. This means putting your money in different stocks and in different fields. For example, you read somewhere that a new startup, Pineapple, is growing rapidly and they're about to release a new piece of technology, the MacBook. Everything looks very promising. You feel that this is going to be the next big thing, bigger than Apple, and you take all the money that you own and invest it into Pineapple. 1 week later, they release the MacBook. Consumers line up and everything seems to be going great. Pineapple stocks rise so high that you think that you're going to be a millionaire overnight. Then the next day, you woke up and you saw news reports that the MacBook are exploding and have already killed a few dozen people. Problem after problem keep on appearing within Pineapple. As all this is happening, the stock of Pineapple is just plummeting down to worthlessness. All that money, time, and effort that you spent would be lost in an instant. Now, what if you had applied the diversifying principle of the intelligent investor? Instead of putting all your money into one stock, you would have been putting it into multiple stocks. Sure, Pineapple might still be losing money, but the other 10 stocks that you chose could have been going up. In the end, you could have still made some money and you wouldn't have lost as much. Graham suggests that when investing in a startup, you should only put a maximum of 10% of your total investment into that one stock. The second principle of being an intelligent investor is knowing that the stock market will not provide you with an insane amount of money instantly. An intelligent investor knows that they will be making a safe and steady income from this. Again, investing in the stock market is not like gambling, and it will certainly not bring you any quick money. Next, you have to understand how to pick the stocks that you want to invest in. Graham recommends understanding the history of the stock market and how it functions. Going back, you can see that there's always been fluctuations and that there will be crashes in the market. Understand that investing in the stock market means having times when your stocks will always go down. Do not think that as soon as your stock goes down, you will lose all your money. A stock will almost always come back up. To illustrate this, if you get punched in the face, you should always get back up because the wound will heal. You wouldn't just lay on the floor and quit life, or in this case, the stock market, because of just one hit. The next step is examining the history of the companies you want to invest in and doing some nice research. How is the company's financial structure? How consistently have they paid their dividends to their investors? What kind of principles are they running with? Do they have a great track record? And do you believe that this company will do well in the long run? A practical tip that Graham mentions in regards to investing in stocks would be to look at the portfolios of profitable investment funds and start with those stocks. Start looking at what they buy and do the research on those. Some might claim that it is cheating and you're just copying the stocks that they own. But that is not the case. When you look at profiles of investment funds that have a history of success, then they will guide you and help you succeed. This can be shown with the quote, "Standing on the Shoulders of Giants" by Isaac Newton. There are many successful investment funds, so you want to stand on them and for the extra boost because they have the extra knowledge and the extra expertise that can help you make you succeed in investing. When determining which stock to invest in, it can be very difficult, but the most important thing is to diversify and do as much research as you can. It is also important to hold the belief that the company you invest in will do well in the long run. If not, you will be selling your stock the first moment you notice it falling. This brings us to the next point. Do not follow others or the market. If you see that a certain stock is going up daily and all of your friends are buying it and telling you how you will miss out if you do not get it and invest, you shouldn't just immediately follow them and buy the stock. An intelligent investor should be doing their research first and seeing if the stock is overpriced, if the company has a good management, and if the company is profitable or not. Only after research should you make the decision on whether to buy the stock or not. Graham goes on even further by saying that as an intelligent investor, there are two different types of paths that one can take: the defensive investor and the enterprising investor. The defensive investor is someone who has a more passive approach to investing. They value security over everything else, but still make a steady income. These people are the ones who go to work and want to start investing as a side hustle. The enterprising investor is someone who has a bit more time and is a bit more active in searching for different stocks. Enterprising investors look for stocks when they are underpriced and then sell them when they are overpriced. We're just going to focus on defensive investors for the sake of this video. After you find the right stock, all you have to do is invest. To invest properly as a defensive investor, you will have to start by using what Graham calls the dollar cost average. This states that you dedicate a small portion of your money every month to invest in the stocks you pick. The reason that the investment is set at a certain amount is so you do not overspend on a certain stock or be swayed to invest in something that you see everyone else is buying. For example, it might look like a stock is going on a fire sale, but remember, as a defensive investor, your priority is safety. Again, this is more of a passive approach to investing. Every month, you would send money to the stocks that you chose to buy. And then, after 6 months, Graham recommends that you check up on the stocks and determine to see if they're still profitable or not. After that checkup, you go right back to investing the set amount to the stocks you have chosen. Finally, Graham recommends that after 12 months, you find a professional and discuss how much money you could possibly increase or decrease from the set amount that you initially chose. This way, you can get a professional view on where your money stands. I really hope that this video is helpful and will be able to make you into somewhat of a better, intelligent investor. If you enjoyed this video, please give it a thumbs up, and if you would like to see more animated book reviews, check out my channel. Thanks for watching, and I'll see you next time.